right now, as you're listening to this, there is like $18 trillion moving at the speed of light on just one single blockchain network.
Yeah, it's staggering.
I mean, it bypasses every major bank on Earth. It operates completely outside traditional banking hours. And, well, traditional Wall Street giants are basically fighting tooth and nail to control it.
Absolutely.
So welcome to this deep dive. Today, our mission is to explore the massive, really explosive rise of stablecoins in 2026.
And we've got some incredible material to go through.
We really do. We are pulling from a fascinating stack of sources for you. We've got a recent Fidelity live stream featuring their top digital asset executives, a comprehensive analysis on institutional adoption and the DTCC.
Right.
And on the other side, a highly critical, deeply provocative Substack essay by a financial analyst known as Janus the Watcher.
And what makes this specific stack of sources so compelling is that, well, they present two completely opposing realities of the exact same events.
Yeah, totally different worlds.
Exactly. I mean, on one side, stablecoins are being hailed as the ultimate necessary upgrade to global finance. And on the other side, they're being described as essentially a ticking systemic time bomb.
Right. And whether you are a hardcore crypto enthusiast, a traditional stock market investor, or honestly, literally just someone buying a cup of coffee on your way to work, this hidden battle over digital dollars is actively reshaping the value of the money in your pocket.
It affects everyone.
It really does. But before we jump in, just a quick note for you listening. Our sources today contain some highly charged economic and, well, political viewpoints regarding government regulation, central banking, and fiat currency.
Yeah, very polarized perspectives.
Right. And we are not taking sides today. We are not endorsing either the sunny institutional perspective or, the doomsday scenario. Our goal is simply to impartially unpack the claims made in these documents so you can fully understand the incredible ideas at play here.
Right. It's about giving you the tools to see the underlying architecture of really what might be the biggest financial shift of our lifetime.
Exactly. So before we get into the potential doomsday scenarios, we need to establish what a stablecoin actually is today and why giant legacy institutions are suddenly so obsessed with them.
Okay, let's unpack this. A stablecoin is not like Dogecoin, right? Or Bitcoin.
No, not at all. The defining feature of cryptocurrencies like Bitcoin is volatility.
Right.
Which, that's a feature, not a bug for speculators. But you cannot run a global business or, buy groceries with something that drops 10% in value while you're standing in the checkout line.
Yeah, that doesn't work.
Right. So a stablecoin is specifically designed for low volatility. Take the Fidelity Digital Dollar, or FIDD, which they discussed in their live stream.
Okay.
It is pegged 1-to-1 to the US dollar.
Meaning for every one digital FIDD token floating around on the blockchain, there is supposedly one actual US dollar or like a highly liquid equivalent sitting in a vault backing it up.
Exactly. So a stablecoin is essentially just a digital claim ticket. Think of it like a coat check ticket. But instead of handing it to a guy at a booth, you can instantly text that ticket to someone in Japan at 2 a.m.
Right. And they inherently trust the physical coat, or in this case, the dollar is still sitting safely in the New York vault.
Wow.
That is the exact mechanism. You get the 204/7 near instant transfer speeds of a blockchain, but with the price stability of the traditional dollar. And look, this is not a fringe experiment anymore.
No, definitely not.
As you mentioned, the one-year transfer value on the Ethereum network alone recently hit $18 trillion.
That number is just insane. 18 trillion.
It's massive.
Yeah.
And traditional institutions are rushing in to capture that volume. The DTCC, the organization that custodies over $114 trillion in traditional assets, they're launching a massive tokenization pilot with companies like Ripple, BlackRock, JP Morgan.
Right, the big players.
They want to move traditional finance onto these blockchain rails.
Which brings us to the legislation. Because to make traditional institutions comfortable enough to move trillions of dollars onto blockchains, they needed regulatory certainty.
They need the rule book.
Exactly. Enter the Genius Act, which was passed in July 2025 and goes fully active in July 2026, alongside another piece of legislation called the Clarity Act. The Genius Act legally mandates this strict 1-to-1 reserve backing for all compliant stablecoins.
Right.
Like if you issue a stablecoin in the U.S., you must back it exclusively with USD cash, short-term treasuries, government money market funds, or treasury-backed repos.
And just to briefly clarify that last term for a second, a treasury-backed repo is essentially just a very short-term loan where government bonds are handed over as collateral.
Got it.
The overarching theme here is extreme safety.
But if it's just a digital representation of a dollar, why do we suddenly need massive federal legislation like the Genius Act to aggressively enforce exactly what these issuers hold in their vaults? I mean, why does the government care so much about the specific composition of those reserves if the blockchain is supposed to be, decentralized?
Well, what's fascinating here is that, according to the institutional perspective, this legislation isn't just about basic consumer protection.
Okay.
It's about integrating cryptocurrency natively into the global financial plumbing without disrupting the traditional banking rails.
Interesting.
By forcing stablecoins to hold the safest possible assets, U.S. Treasuries, the government is ensuring that this new $18 trillion digital economy doesn't accidentally build its foundation on toxic debt.
Ah, I see.
It provides the literal regulatory certainty that giants like Fidelity and BlackRock demand before they deploy real capital.
Okay, so that paints a picture of the government building a safe, regulated sandbox for the big kids to play in.
Exactly.
But here's where it gets really interesting. Because the Substack essay by Janus the Watcher looks at this exact same legislation, the Genius Act, and sees a completely different motive.
A very dark motive.
Yeah, Janus argues this isn't about consumer protection at all. Janus claims it is a desperate, engineered mechanism to force the market to buy U.S. government debt.
Right, and to understand Janus's forced buyer thesis, we have to look at what the essay calls the fracturing of the U.S. dollar.
Okay.
Because we tend to think the dollar is worth the same everywhere. But Janus argues the dollar has actually fractured into 3 concentric rings globally.
3 rings.
Yeah. Ring 1 is the U.S. and its closest allies, like the U.K., Japan, and the Eurozone core, who have direct swap lines with the Federal Reserve.
Let's pause on that because swap lines sound like deep central banking jargon. Like, how does a swap line actually work in practice?
A swap line is basically an emergency pipeline between central banks. If, say, European banks suddenly need U.S. dollars to settle trades, but dollars are scarce, the U.S. Federal Reserve will essentially print dollars, swap them with the European Central Bank in exchange for euros.
Oh, I see.
And then the ECB lends those dollars out to its local banks. It guarantees that Ring 1 allies always have the dollar liquidity they need. They get the standard managed price of the dollar.
Okay, so then Ring 2 includes the broader OECD nations and Gulf allies, who, from the source, usually get the normal price, but it gets strained under stress.
Right.
And Ring 3 is frontier markets, places like Sri Lanka, Pakistan, Argentina, and they do not have access to those direct Fed swap lines.
Exactly. And in Ring 3, the dollar is becoming incredibly scarce and wildly expensive. Janus points to a stunning disconnect in the price of oil to prove this.
This part blew my mind.
Yeah, in April 2026, the Saudi finance minister stood on stage at the IMF and said that the $90 a barrel price of oil you see on your financial screen in New York is basically a fiction.
A fiction. Wow.
He stated the real physical price to actually get a barrel delivered to a developing nation was sitting between $120 and $160.
And the CEO of HSBC noted that he saw Sri Lanka paying up to $286 for a single barrel of oil.
It's unbelievable.
286. Because they had to pay for war risk insurance, shipping reroutes, and most importantly, they had to somehow acquire dollars to pay for it when dollars were drying up in their region.
Right.
So you have this massive gap between the paper price of oil on Wall Street and the physical price of oil in the developing world.
And Janus calls this the collateral fiction. But this collateral fiction isn't just an overseas problem. It is actively creeping into corporate balance sheets.
Right.
Janus highlights a BlackRock Asia-Pacific private credit fund that experienced its first default with a Chinese cold chain company called Metcold Holdings.
And the essay mentioned they defaulted due to a currency mismatch. So walk us through the math of how a currency mismatch actually bankrupts a healthy company.
Sure. So the underlying business of Metcold was totally fine. They were delivering goods and earning revenue in Chinese yuan.
Okay.
But their debt was denominated in U.S. dollars. When the U.S. dollar gets stronger and more expensive globally, it takes significantly more yuan to buy the exact same amount of dollars to pay back the loan.
Oh, man.
So even though their business was operated normally, the shifting value of the dollar mathematically suffocated them. They defaulted.
Wow.
The foundation is shifting under their feet.
Which brings us back to domestic policy, which is exactly what former Treasury Secretary Henry Paulson warns about in our sources.
Yeah.
Paulson explicitly points out the extreme danger of hitting a wall where the U.S. government is trying to issue treasuries, which is, how the government borrows money to function.
Right.
And the Federal Reserve is the only buyer showing up to the auction.
Yeah, because foreign central banks are increasingly becoming net sellers of U.S. debt, and domestic banks are completely tapped out. So the U.S. government has a massive growing supply of debt and a shrinking pool of organic buyers.
Okay, so connecting the motive back to the stablecoin sandbox we just discussed, Janus's core thesis is that the Genius Act was essentially designed to solve this exact problem.
Precisely.
By legally mandating that stablecoins back their tokens with short-term treasuries, the government is instantly creating an estimated $800 billion to $1 trillion of new incremental demand for U.S. Treasury bills by 2028.
They become forced buyers. A stablecoin issuer cannot choose to buy corporate bonds or real estate or gold. By law, to operate in the U.S., they must buy government debt.
It sounds like a failing restaurant forcing his own waiters to buy the unsold soup every night just so the kitchen doesn't go bankrupt.
That is a perfect analogy.
But if the government is engineering demand through stablecoin legislation, doesn't that inherently mean organic global demand for the U.S. dollar is failing?
That is the exact conclusion Janus draws. And Janus explains this using a concept called the Cantillon geography. So, the original Cantillon effect is an economic theory that says when new money is printed, the people closest to the printer benefit the most before prices rise across the economy.
Makes sense.
Janus argues this is now happening geographically. The closer a nation is to the U.S. Federal Reserve Ring 1, the cooler the inflation burns. But the further out you go, to Ring 3, the hotter the inflation burns and the more expensive basic commodities become. So, in Janus's view, the U.S. is masking this global dollar fracture by forcing the crypto industry to act as an artificial buyer for its debt.
Okay, but if Janus is right, and stablecoins are essentially just massive forced hordes of U.S. treasuries propping up the government's fiscal math, what happens if the crypto market panics?
Yeah.
Like, what happens if everyone holding that $18 trillion in digital volume tries to cash out their digital claim tickets for real dollars at the exact same time?
Well, this is where Janus's warning turns from a structural critique into a blaring systemic alarm bell. Janus argues that stablecoins are, in functional reality, the exact same thing as money market funds, or MMFs, from the 2008 financial crisis.
Wait, comparing this to a 2008 money market fund is a massive accusation. If I remember correctly, those funds were supposed to be completely risk-free, right, until Lehman Brothers collapsed.
Exactly. They held very safe, short-duration paper. But in September 2008, a massive fund called the Reserve Primary Fund had exposure to Lehman. Investors panicked and tried to pull their cash out all at once.
A bank run.
Exactly. The fund had to sell its assets into a frozen market, and it broke the buck, meaning its value dropped below $1.
Which triggered a massive contagion. Everyone tried to pull their money out of all MMFs across the board.
Right. And within 72 hours, the U.S. Treasury stepped in and used something called the Exchange Stabilization Fund, the ESF, to guarantee the MMS.
They bailed them out.
Basically. They contained the panic because they had that ESF war chest ready to deploy. After that, regulators implemented strict new rules, primarily Rule 2A7.
And what exactly did Rule 2A7 change to stop that from happening again?
So, Rule 2A7 placed incredibly strict limits on the maturity and credit quality of the assets a fund could hold. Regulators also introduced redemption gates, which allow a fund to legally pause withdrawals during a panic to stop a bank run.
Okay, that makes sense.
And crucially, they implemented a floating NAV net asset value.
Which means, instead of promising the fund will always perfectly equal $1, a floating NAV allows the price of the fund to naturally bend and fluctuate with the market.
Exactly.
If the assets lose a tiny bit of value, the fund price dips to 99 cents. It bends, so it doesn't just snap and trigger a psychological panic.
Right. But according to Janus, the Genius Act takes this exact same business model, taking cash, buying short-term debt, and promising a fixed $1 value but strips away all the safety nets we invented after 2008.
Wait, really?
Yeah. There are no discretionary liquidity fees, no redemption gates to slow down a panic, no floating NAV, and crucially, no direct access to the Federal Reserve's emergency lending windows.
Wait, so you're telling me we took the exact financial vehicle that caused the 2008 crash, ripped out the emergency brakes we invented after 2008, and strapped it to a blockchain that moves at the speed of light?
That is exactly what Janus is arguing. And the timing on this couldn't be worse. Remember that emergency war chest, the Exchange Stabilization Fund? That saved the day in 2008.
Yeah.
In April 2026, U.S. Treasury Secretary Scott Bessent testified before Congress that the ESF is now actively tied up providing foreign exchange swap lines for allies like the UAE.
Oh.
They are using the domestic emergency net to provide dollar liquidity abroad to keep those allies from ditching the dollar entirely.
So the safety net is gone.
Exactly, which raises an important question. What does a digital bank run actually look like?
Right.
Because Janus points out that a traditional bank run, like we saw with Silicon Valley Bank, takes days to play out. But a stablecoin run takes blocks. It happens in seconds.
Walk us through why it's so much faster. I mean, a traditional bank run involves human behavior, business hours, interbank credit lines. Why does a blockchain fundamentally change the speed of a collapse?
Because a blockchain utilizes automated smart contracts. If a decentralized finance protocol sees the price of a stablecoin drop to 99 cents, the smart contract doesn't call a human risk manager to ask for permission to sell.
Well, of course.
It automatically liquidates the position instantly. Millions of automated liquidations trigger simultaneously. The contagion vector isn't interbank credit lines anymore. It's the 247 global settlement rails themselves.
So if you have a stablecoin and you want your money back at 3 a.m. on a Sunday, the stablecoin issuer has to sell their U.S. treasuries to give you the cash. But if the secondary treasury market is frozen like it was in March 2020 during the pandemic shock, they simply cannot sell.
Exactly. And Janus maps out the different architectures of the major stablecoins to show that none of them are truly immune to this mechanism.
Okay, let's hear it.
You have USDC, which has deep ties to the traditional banking system, offering an informal, implicit backstop. You have RLUSD from Ripple, which uses a New York Department of Financial Services supervisory framework.
That sounds safe.
It sounds safe, but Janus specifically notes that state-level supervision is not the same as having a federal resolution authority if things really blow up.
Right.
And then you have Tether, USDT, which is totally offshore with no comparable supervisory regime at all.
So no matter which flavor of stablecoin you look at, if that secondary treasury market freezes, the one-to-one peg only holds until the physical cash on hand runs out.
Right.
And then the music stops for the entire global digital economy simultaneously.
That is the kill switch. If the peg breaks, the damage doesn't just hit Wall Street. It instantly hits every merchant accepting that stablecoin, every remittance corridor sending money to families overseas, and every decentralized finance protocol that uses it as collateral.
Okay, my head is spinning. We have two incredibly persuasive, incredibly extreme realities here.
Yeah, it's a lot.
On one hand, we have Fidelity and the DTCC rolling out a $114 trillion institutional tokenization master plan that promises to make global finance faster, cheaper, more efficient. And on the other hand, we have Janus the Watcher outlining a ticking systemic kill switch built on forced government debt and shadow banking risks.
Exactly.
But Janus cannot just yell doomsday without giving us a way to measure it. Did the essay actually provide a scorecard to track if this is happening?
Yes, thankfully. Janus provides us with specific falsifiability metrics. Essentially, a scorecard to prove the doomsday thesis wrong. First, benchmark spreads converging.
Meaning, if the physical price of oil in Sri Lanka and the paper price of oil in New York start to match up again within 6 months, why does that invalidate the thesis?
Because if those prices match, it means dollar liquidity successfully reaching the edges of the global economy again. It proves the dollar is not fracturing as badly as Janus thinks.
Okay.
The second metric is if the U.S. dollar index stabilizes through the third quarter of 2026 without emerging market premia spiking.
And emerging market premia spiking is just like a complex way of saying that investors are suddenly demanding much higher interest rates to take on the risk of holding debt in developing countries.
Exactly.
So if that premium doesn't spike, panic isn't spreading, what else is on the scorecard?
Third, if the Federal Reserve is able to stay out of the Treasury market. If private organic demand is strong enough that the Fed doesn't have to step in as the buyer of last resort by Q3 2026, then stablecoins aren't the only thing propping up the government. And finally, if stablecoin issuers are officially granted access to federal liquidity facilities, if regulators explicitly give them that safety net, the 2008 kill switch scenario is neutralized.
Okay, and to be fair to the sunny side of our sources, the institutional rollout we are seeing from the DTCC and Ripple actively suggests they're building an orderly migration.
Right. They aren't trying to build a rogue shadow banking system.
No.
They are actively working with regulators to fix the very liquidity issues Janus is worried about.
Yep.
The Fidelity live stream made it very clear. They view this as the next evolution of safe, secure cash management.
It creates a fascinating asymmetry table for anyone watching this space.
Yeah.
I mean, if Janus is right, A fast stablecoin run is a catastrophic downside risk that the broader market has not fully priced in.
Absolutely.
But the flip side is that if the institutions are right and this tokenization rollout works, it secures global US dollar dominance for the next century by making it the native, frictionless currency of the digital internet.
So what does this all mean?
Yeah, for the person listening right now who might just be using stablecoins to avoid transaction fees when sending money to a relative or, holding some dry powder in a crypto brokerage account waiting to buy a dip,
Yeah.
are they standing on a brilliant high-tech bridge to a unified global economy? Or are they standing on a fragile Band-Aid covering a fracturing financial system?
Well, if we connect this to the bigger picture, it means you can no longer afford to view stablecoins as just a quirky crypto side project. They are rapidly becoming the new underlying plumbing of the global economy. The risk-reward trade-off is massive. You get the incredible utility of instant borderless transactions, but you are participating in a completely untested macroeconomic experiment.
It's wild.
You need to watch those falsifiability metrics carefully. Watch the price of physical oil versus paper oil. Watch the treasury auction.
Because what happens in those boring, routine government bond auctions might literally determine if the digital claim ticket on your phone is worth $1 or worth $0 tomorrow morning.
Exactly.
Well, we have covered incredible ground today. We started with Fidelity's highly optimistic vision of a future where instant 2047 digital cash makes the global economy work for everyone seamlessly and securely.
Yeah.
But we also walked through the dark structural warnings from Janus the Watcher, the idea that this entire system is actually just a desperate mechanism to force crypto to buy U.S. debt, creating a shadow money market fund strapped to a light-speed blockchain kill switch.
It is a perfect encapsulation of where global finance stands in 2026. I mean, the technology is undeniably revolutionary, but the underlying economics are still tied to the exact same human incentive and systemic risks we have wrestled with for decades.
Absolutely. I want to sincerely thank you for joining us on this intense deep dive today. Taking the time to understand these complex hidden gears of the economy is the absolute best way to protect yourself and spot the real opportunities in the noise. Thank you for bringing your curiosity.
It's been great.
Before we go, I want to leave you with one final provocative thought to mull over on your own. We have talked a lot today about whether stablecoins can save the US dollar by making it fully digital and universally accessible. But think back to the scale of this network.
Right.
If stablecoins truly succeed, if they successfully tokenize the US dollar and spread it instantly to every single smartphone on Earth, completely bypassing every traditional bank, does that actually save the national currency? Or does it accidentally create a new borderless digital empire where the blockchain eventually replaces the need for a central bank entirely? Until next time, keep diving deep.